Hello, everyone. Good to be back with you. We are here for our May market update with Rick Sharga. Special guest, Peter Rusconi. Welcome.
Thank you. Thank you.
It's going to be a great conversation today. Lots of cool things going on in the mortgage industry. We are in full spring buyer season. And Rick, some of the data is showing that even with the increased interest rates, folks are getting out there and transacting in the existing marketplaces. We're seeing some data sort of ticking up. What are you seeing?
Always good to see you, Jeff, and welcome, Peter. The data that we're seeing has been sort of dismal for the first quarter. If there are some green shoots coming in the spring, it looks like it's in the form of pending home sales. And that's true for both existing homes, where pending sales are up about 11% year over year, and in new homes, where pending sales are up about 3%. And for people that aren't familiar with the pending home numbers, these are basically contracts that are being entered into to complete a sales transaction, and usually they're a pretty good predictor of what we're going to see in the next month to 60 days. So there is some hope that as we get further into the spring selling season, we'll start to see an improvement in the number of homes that are sold, both in the existing and new home categories.
So one of the certain green shoots that we've seen over the past couple of years, and one of the bright spots, has been new construction. We've talked about it at length. Is that beginning to transition at all? Is it leveling off? How are the prices holding up? Like, what's going on there?
Yeah, great questions, Jeff. On the new home side of things, sales continue to be much stronger than they are, relatively speaking, on the existing home front. What we're seeing in new homes is sales are up about 9% month over month, about 8% year over year. So the volume is actually increasing, and that's increasing at a time when the builders have kind of kicked into gear a little bit. There are about 1.6 million homes currently under construction, and they're moving toward kind of filling that gap we have in the lack of homes that are available for people that want to become homeowners. So on the new home front as well, one of the things that we're seeing is prices continue to go down. They've gone down marginally month over month and year over year. They're down probably about 15% from the peak. And the gap between the median sales price of a new home and the median sales price of an existing home has narrowed about as much as I've seen it in the past couple decades. So in a lot of cases, buyers are really much more motivated to go find those new homes because they're available, because they don't cost much more, because they are brand new, and because in a lot of cases, the new home builder is offering advantageous mortgage rates, 4.95, 5.9% rates compared to the 7 and 7.5% rates you're going to get on an existing home.
Certainly, we've seen that in the marketplace. We've seen investors today having struggles to acquire homes. A great deal of our investors today are beginning to look at new construction.
Absolutely. When an investor has a new construction build versus an outstanding home that's, say, built in 1930, they have a unique opportunity to actually charge more for their monthly rent, right? And especially as we have higher interest rates, that's a huge step up for them to be able to cash flow the property, right? Obviously, a lot of this data is for home buyers, owner occupancy. How does this compare to the investors? Do you see more and more investors going into these new builds versus existing homes, or do you have any data on new homes versus renovations? Are people jumping into these long-term holds versus choosing to do a fix and flip, then refinance those older homes out?
Yeah, you have a couple of questions in there, Peter. I'll try and address them one at a time. We are seeing more money being spent by large investors, institutional investors, on ground-up construction, and we're seeing build-to-rent communities really popping up across the country, particularly in the South and Southwest. Atlanta probably being the epicenter of that kind of build-to-rent community construction. I'm kind of surprised the institutional investors waited as long as they did to get into that mode. because as you were pointing out, you're getting a high quality product. You know what the maintenance costs are going to look like. You have much more control over the materials and the appliances and so forth that are in place. And so it's a much more predictable model than going out and competing with individuals over existing homes. One of the things that we've seen from an investor perspective, and this has really shown up in the last several quarters of the RCN Investor Sentiment Survey that we do, is a move away from fix and flip investing toward that longer hold rental property investing. And that makes a lot of sense because the market has been sort of slanted against the type of market that really is optimal for fix and flip investors. If you're a flipper, you're really looking for low inventory, rapidly rising prices, and very, very strong demand. And those components haven't all been in place really since mortgage rates started to jump up. That demand curve has flattened out pretty significantly. And the buyer who would have been interested in your $400,000 flip when mortgage rates were 3% is now looking at a $200,000 property that you don't have budgeted as a flipper. So we've seen a lot of those folks, or at least a lot of the investing activity going toward rentals as opposed to fix and flip properties. That does also marry well with where we're seeing market opportunity. There are several million young adults across the country who would have preferred to have bought a house and still aspire to home ownership, who simply can't afford to buy one today because of the high prices and the relatively high mortgage rates. So they're deciding they're going to rent a little while longer, or as they're coming of age, moving out of their parents' houses, they're going to be renting now instead of buying as they form their households. So lots of opportunities for rental property investors. And one of the opportunities for rental property investors is to look at closeout deals when a new home builder is finishing up a community or a project. You're looking at something that's competitively priced. If you can make the numbers pencil out for what you can charge for rent, sometimes those are overlooked opportunities that investors really don't think about.
You know, it's interesting, Rick, some of the overall, we'll call it news media attention on the lack of housing in the United States today often focuses on what the large institutional publicly traded companies have done or are doing to participate in that marketplace, typically acquiring homes, renting them out for families to live in. And certainly there's been some discussion about whether that's helping, hurting the marketplace. In your previous comments, you mentioned the larger institutional aggregators are now really getting serious about building homes. I would think that would play very well to help solve some of the housing crisis that we're in today.
Well, the build to rent model, at the very least, should take these large institutional investors out of the bullseye that they've been in from legislators and activists and the media in general, accusing them of competing unfairly with first-time buyers for limited inventory and making it impossible for people to own homes. You know, and I know, and I think people that follow this industry know that the institutional investors collectively own about 3% of the single-family rental properties out there. So the headlines you're reading are largely misleading. Wall Street is not gobbling up Main Street, no matter what it says in your local paper. There are some markets where institutions own a higher share than others. You're looking at markets like Atlanta and Charlotte and Phoenix and maybe Las Vegas. But by and large, across the country, that's simply not the case. In fact, what we're seeing with this build to rent model is additional inventory coming to market. So not only are the investors not any longer competing with those first time buyers for the existing stock, but they're bringing new stock to the market. And I think overall that's a win-win for the housing market.
Yeah, that really is good news, Peter. I mean, it really is. Anytime you're addressing a shortage in the marketplace, no matter what it is, and capitalism comes in and says, we have a way to solve this problem, and new construction is certainly the way to go. I know that, as mentioned earlier, some of our investors are thinking about that. And I think what Rick is saying here is good news for everyone.
Yeah, absolutely. We're still in such an undersupply of housing across the U.S. Apartments are a big thing too. I personally live in an apartment out of choice. And it's fantastic. There's no overhead compared to a house, especially where we're located. There's not too much new builds going on in the immediate vicinity, where other markets like Atlanta, out west, who have all these people traveling there or immigrating there, have a lot more opportunity to buy these new builds. Does this translate to apartment units too? This data about the new starts, the affordability of building these apartment units versus buying a currently built one that's been around for a while. How does that compare to the SFRs?
Yeah, we're in a period right now where there's an all-time record number of apartments coming online. We've seen housing numbers. Let me do that again. We've seen reports that housing starts are down year over year, and that's true in aggregate, but it's mostly true because we've seen a pretty significant drop off in multifamily housing starts. If you look at single family housing starts, they're actually up about 19% year over year. But the reason we're seeing a drop off in multifamily starts is because at the moment, there's between 900,000 and 1 million apartment units under construction. And we've seen many, many apartment units come online in the last 6 months. So we're actually running the risk of some markets being a little bit oversupplied with apartments. And we're not seeing nearly that kind of additional inventory coming to market on the single family rental side. So it's interesting to see what the builders are doing, and they do tend to shift with market demands to a certain extent. And I think right now they're clearly turning their attention back to more owner-occupied single-family property construction.
How does that impact the rental rate growth? We talk about comparing the SFR rental rate for either new builds or existing versus the new build or existing multifamilies for apartments. Do they align? Is there a difference within that rate growth?
The rental rates for single-family rental homes have held up better over the last year than the rental rates on multifamily dwellings, apartment units. Right now, if you look across the country, the average rental growth rate for apartments year over year for asking rents is 0. And in quite a few markets, the number is just a little bit negative, but still negative. On the other hand, if you're looking at single-family rental properties, typically homes, on average, they're up about 2.5% to 3% year over year. Not a huge amount, but still positive and still showing growing rent. A lot of that does come down to supply and demand. As I mentioned, there are somewhere north of 900,000 new apartment units under construction. They're all coming to market. In some cases, that floods the market and limits the bidding wars the tenants used to be able to do to get these prime locations. And there's another difference, which is the nature of the renter in a single family rental unit versus an apartment unit. Typically, the SFR renter is a little bit older, a little bit better off financially, probably as a family, maybe looking to move into a particular school district or other prime location. And so they're willing to spend a little bit more. So it's a slightly different market dynamic, a slightly different ecosystem. But by and large, we are seeing the single family rental rates hold up a little bit better.
Go right ahead.
Thanks. On the rental data, typically the reports and data we see come back is lagging a little bit. So how does that impact these inflation numbers? Are the data for rents coming back artificially inflating that, or are these actually accurate?
For reasons that I have never really been able to figure out, when the government puts out its inflation numbers, particularly the CPI, it uses lagging housing data. The data lags by as much as a year. And that's really critical when you see a CPI report come out, because about 37% of the CPI is built around housing costs. And the housing cost that the government looks at is what people are paying for rent, as they're moving in, and what they would pay in rental equivalent if they happen to be in a house. So what that house would rent for as opposed to what they're paying on their mortgage. And the fact that we're looking at rental rates that a year ago were increasing by 5.5, 6%, and that's factored into the inflation numbers, suggests to me that the numbers we're seeing today are a little bit overinflated, but also leads me to believe that as we move forward and the housing data starts to catch up, we will see inflation start to move down closer to the Fed's 2% target rate. And that ultimately will be good news for the entire economy and particularly for the mortgage and housing industries that have really suffered since the Fed started raising the Fed funds rate a couple of years ago.
I wanted to touch on geography, and certainly you mentioned this massive wave of apartments coming online. I've seen data that the Northeast, which is so apartment-centric, is holding up amazingly well, and other communities such as Nashville, which I think is in the bullseye right now for new apartments coming online. Certainly Austin has been well documented. Maybe a little background on what you're hearing about from an inventory perspective, geography-wise, what we're going to see in the coming months.
Well, Jeff, the way you characterized it is spot on. If you look at an area like the Northeast, which was already fairly dense in terms of the number of apartments as part of the housing market, there's not a ton of construction going on up there. And so rental rates have held pretty well. And will continue to do so because there are usually more people looking than there are units available, or it's at least relatively balanced. A lot of the new construction is going on in the South and the Southeast. And as those new apartments come online, in some cases, they're outstripping market demand. And so it's a little bit harder for the landlords to get what they'd like to get in terms of market value for those rental properties. So it, is as much as we get tired of talking about it all the time, very much like the owner-occupied market when it comes to home prices, when it comes to rental rates, a lot of this simply comes down to supply and demand. And there's more supply coming on market very, very quickly than there is demand to meet it. I think that will balance out over time. We continue to see population and job growth in those markets in the South and Southeast, but there will be a little bit of a disruption temporarily while these apartments come online before the new tenants come in.
I want to go back to new construction again, and certainly we've touched on single family, we've touched on apartments. Some of the data is showing that single family starts now by the large builders and even regional and local are leveling off. What do we expect to see as this year unfolds from a new start perspective on single family, and where do you think that actually even goes further into 26?
Yeah, I'm a little bit of a contrarian here. I really don't believe we're seeing much of a slowdown, at least nationally, when it comes to housing starts, at least not on a year-over-year basis. What we are seeing is, again, a 19% increase in housing starts for single-family homes intended for owner-occupants. If we keep going at that level, it will go a long way over the next couple of years toward meeting the need we have, because we do have that deficit in homes relative to our population. There's something else you need to keep in mind when we're talking about new home construction. We're almost back to normal levels, pre-pandemic levels, historical levels of completed homes available for sale. Typically, we're looking for about an 8-month supply, and we're right about there when it comes to completed homes. About a year ago, the builders had a record number of homes under construction, all-time high. And that was not because they were building rapidly, it was because they had supply chain issues. They couldn't find labor to build the properties. And so they just wound up with this backlog of homes that they'd started but couldn't finish. And that backlog has been coming down, but it's still a pretty large number of homes under construction. And then if you look at permits, if you look at homes that the construction hasn't started yet, they're actually at an all-time high. So I think the builders are very optimistic about what's to come. They're still getting permits at fairly high numbers. Still a lot of properties under construction. I just don't see any signs in the numbers right now that suggest that builders have soured on the market or are going to pull back significantly. So I'm very optimistic that we continue to see a pretty strong showing in terms of new home construction.
And you touched on this earlier, and Peter, it's certainly something that we see in our marketplace with investors, which is the ability to manipulate rates through buy downs and such, right? On our side of it, for investors, a lot of times investors will come to us with a tremendous amount of equity in their properties, and they're going to be having a loan terming out, and they use some of that equity to buy that rate down. And it really goes a long way to locking in a much more affordable rate going, especially when so much equity has been created over the past 3 or 4 years in the United States. But on the new construction side, the builders are doing something just as interesting, which is participating in the buy down of the rates at the closing table, allowing homeowners to be able to afford these new homes.
Yeah, it's a great olive branch to everyone who's trying to get out of their current home, or someone who has equity but does not want to necessarily move because of the interest rates we currently have. Builders are doing a fantastic job of bridging that gap, providing the opportunity and desire for them to actually move out, right? Because equity is such an important thing right now, especially, like you said, being able to buy down the interest rates. There's a certain break-even point where if you buy it down, eventually you start making that money back with the proceeds and discounts that you had originally. That equity is going to be what gets you to the point you want to be in a raising interest rate environment, or a higher interest rate environment rather.
Yeah, no, without a doubt. It's super interesting. Equity, and Rick, we've talked about this over the past, it's got to be over a year now. We have talked about that equity and what that's going to do to protect homeowners that might get themselves into trouble and keep them out of that foreclosure process because of that tremendous amount of equity that's been created over the past few years.
Yeah, equity is it's invaluable, and there's about $32 trillion of homeowner equity across the country right now, an all-time record.
32 trillion.
With a T, yes, $32 trillion in homeowner equity, according to Freddie Mac, and it can help prevent a foreclosure, or at least give a borrower better options than they would have had, say, back during the Great Recession, when 30 to 40% of all homeowners were underwater on their loans, and virtually everybody in foreclosure owed more on their loan than their home was worth. So having a lot of equity in your home won't prevent you from defaulting on the loan. If you lose your job and can't make your monthly payments, you could still default. You could still get that first foreclosure notice. But if you have that equity, it gives you at least the option, once you get that notice, of being able to sell the property. And in today's market, you're probably selling it at or very close to full market value, and protecting that equity so you walk away and get a fresh start, rather than risking losing everything at a foreclosure sale. And we're seeing that happen in fairly large numbers. About 55 to 65% of all distressed property sales right now are being done at the pre-foreclosure period, which is after that borrower gets that first notice, but before the foreclosure auction takes place. And that's something we haven't seen in prior cycles. So borrowers are absolutely leveraging that equity to protect themselves and avoid that ultimate foreclosure. But something you guys talked about, I wanted to go back to for a second. I think what the builders are doing with their buy downs of rates is just incredibly smart. In the first place, again, we're seeing that the median price of a new home isn't dramatically higher than the median price of a similar existing home. And that's not always the case, but it's certainly true right now. And what the builders are doing is kind of brilliant. They're bringing cash to closing, and they're buying down mortgage rates by buying points, and it makes that property much more affordable. I spoke to a group in Denver not long ago where there was a builder advertising rates at 4.9%. Permanent rates, by the way. But what the builders are able to do when they do that is rather than discount a property by $20,000 or $30,000, which then lowers the comps for the next property they try and sell, they're just bringing the same amount of money to the table at closing. And so that protects their price, but gives their buyer a better deal. It's a brilliant strategy, and it's a shame we can't do something like that in the existing home market.
Yeah, well said. Speaking of the existing home market, seeing that listings are ticking up for existing homes, where are we compared to normal? Are we getting there yet? How are things looking?
Yeah, new listings are inventory, Jeff. They're 20% up from where we were a year ago, which is really significant. They're also 20% below where we've been historically, which is also significant. But they're moving in the right direction. And if you're an investor in today's market, this is really good news because there simply hasn't been anything to buy for the last couple of years. And so the fact that we're getting new listings, I believe from Housing Wire and Altos research we saw in the last week about 71,000 new listings. That gives investors an opportunity to go find something. And the fact that we've seen a little bit of a pullback in consumer demand for these homes means there's a little bit less competition. And the fact that the institutions are doing ground up construction means there's a little less competition. So not a bad time to be on the market if you are an individual investor, a mid-sized investor, looking for some inventory to either fix and flip or hold on to as a long-term rental, because really we can say this with some certainty for the first time in a few years, there is more inventory than there has been in recent times. And it looks, for all intents and purposes, like we're going to continue to see that inventory growth. Part of that, by the way, is new home listings. Part of it is it's simply taking a little longer to sell the properties once they're listed. So again, as an investor, you want to keep an eye on those properties that have been on the market for a little while, because at that point you may have a somewhat more motivated seller who's willing to negotiate a better deal.
Do we see that often where sellers are discounting that listing price in certain markets?
Another great question. What most people don't realize is that in an average year, about a third of all listed properties take a price reduction before they're sold. What we're seeing in the first quarter is we're right at the top end of that range. It's about 33.5% of properties that are listed for sale are requiring a list price reduction before they're sold. So there are opportunities, and it depends on the needs of the seller. If they really need to get out from the property, if they really have a strong desire to go buy a new house and want to move, maybe they'll drop the list price. We were talking earlier about Peter, about glass half full, glass half empty. If you're looking at the market from a glass half full perspective as a seller, 33% of homes requiring a list price reduction means that 67% don't. And we're also seeing a fair number of properties sell for over list price. So it really comes down to what's going on in your local market, and you need to be paying close attention to those local market trends rather than pay too much attention to what's going on nationally, because your conditions are going to vary pretty dramatically. If you're in Austin, you're likely to see price reductions. If you're in San Jose at the high end of the market, or Seattle, you're likely to see some home price reductions. If you're in Central or Northern Florida, if you're in the Carolinas, if you're in Virginia, you may be seeing home prices sell above list price. So it's a very localized phenomenon we're seeing across the country right now.
I'd love to touch on California for a minute there, Rick, your home state. Some of these conversations we've had over the past year has been pretty doom and gloom for not all of California, but a great deal of it. But it seems like things have turned a little bit in this spring season. Some of the data I've been seeing showing that California may have, while not all geography in California, a large swath has turned the corner.
Yeah, at the risk of getting out over my skis here, it does appear that California may have bottomed out and is coming back up. If that indeed is the case, it's probably a good thing for the rest of the country because California tends to be a bellwether when it comes to real estate trends. And so if the state has bottomed out and is coming back, maybe that's a foreshadowing what we're going to see across the country at large. Um, the affordability issue is still a real challenge in California. There was a report that came out just today that my home county, Orange County, now on average requires a household income of $349,000 to be able to buy the median priced home. Just insanely expensive. So affordability continues to be a challenge for a lot of California. We're seeing a lot of the growth in the state, in the Central Valley, in inland parts of the state, like Riverside and San Bernardino counties, a little bit closer to the central part of the state, away from the coastal areas. But we're seeing price increases in places like San Diego, even in parts of LA County. And so it in California, in very many cases, it comes down to micro regions. So if you're in the Bay Area, if you're looking at an entry level home, prices are still probably going up, and the properties are selling as soon as they're listed. If you're looking at, the higher end of the market, you might not have as much interest in it, and prices may be coming down. So it's really a micro regional, multi-tiered kind of complex market here in California. But that's fitting, since I believe California is the only state in the country where real estate's a recognized religion.
So the fact that the reports have said everyone's leaving California seem to be greatly exaggerated.
I wouldn't go there. I wouldn't go there. California is still on net losing hundreds of thousands of people a year. So people are moving out of California. I think there's also a large number of people that are moving from expensive parts of California to less expensive parts of California. So you're seeing people move out of Orange County and LA County and San Diego County into Riverside and San Bernardino and other parts of the Inland Empire. You're seeing people move out of the Bay Area into Sacramento and Merced and Fresno. So there is some of that, but we absolutely are seeing people move out of the state, looking for, if not greener pastures, at least places where the greener pastures don't cost quite as much.
Makes sense. So touching on geography, Peter, here at RCN, we've seen a great deal of interest in the Midwest.
A lot of Midwest.
Yeah.
Not many places, as you talked about, where your median home income needs to be $300,000. Luckily, the Midwest doesn't have that as an issue for them. So we see a lot of availability there as people start moving out, for investors to actually take those lower priced homes and create a much higher standard for the type of housing out there.
It's interesting. And Rick, it seems to be a wide swath of the Midwest, all the way from greater Chicagoland, it's certainly down the Mississippi and through the Ohio Valley, and certainly west through Kansas as well. It seems to be a real trend, Rick.
Yeah, actually, the only pushback I would give you on what we're talking about when it comes to the Midwest is probably Chicago proper. We're still seeing population exiting Chicago, which causes Illinois' annual population trends to look slightly negative. But it's not like they're moving to Guam. They're maybe moving, across state lines into Wisconsin, maybe moving into Milwaukee and commuting or working from home. Indiana has been doing extremely well. A hidden gem when it comes to real estate, and everybody's surprised when I say this, is Ohio. We're seeing a lot of growth, a lot of activity in Ohio. When I talk to individual investors, when I talk to real estate professionals, one of the things I always fall back to is saying, follow the money. And a lot of the institutional investors are investing heavily in Midwestern states because, as you were saying, you can buy a property or you can build a property for a fairly affordable amount of money, and then turn it into an immediate cash flow, a revenue producer, by charging a market rent, and that's something you can't do in states like California or New York or Massachusetts quite as easily because your table stakes are a lot higher. So we are seeing a lot of movement toward the Midwest now, in addition to the South and Southeast. The regions are very affordable. We are seeing job growth in those markets. And as we're seeing manufacturing jobs come back into the states, those are the states that tend to get those kind of facilities and those jobs. So again, if you're an investor looking for opportunities, that's a very fertile region of the country to be looking at.
So as we close in on the end of our May monthly update, folks, buckle up. We haven't touched on interest rates or Jerome Powell's musings on the next rate cut. Rick, here we go. When is that rate cut coming? That's what everyone wants to know.
It's a shame we didn't have this conversation a couple months ago, because I would have had a very different answer for you then, and a much more optimistic one. Every forecaster I know has adjusted their numbers for the year because inflation did not behave the way the Fed wanted it to during the early part of the spring. And because of that, they're very unlikely to make a rate cut to the Fed funds rate until at the very earliest sometime in September. I wouldn't be surprised if it lags even a little bit further than that. Until we see the Fed execute a rate cut, or at least announce one that's coming, we're not going to see mortgage rates budge very much. So mortgage rates have been trading in a very narrow band between 7 and 7.5% for the last couple of months. I fully expect they will trend that. They'll continue to trade in that narrow band over the course of the summer. And because of that, affordability continues to be constrained in the housing market. And because of that, capital is expensive in the private lending market. And so it's investors are going to be looking at the same kind of price points on their loans that they've been looking at for a while. So I honestly think we're pretty much on hold until the Fed decides to actually execute a rate cut. I don't expect that's going to happen at the earliest until September. And because of that, I don't think mortgage rates wind up getting down to nearly as low a percentage area as we'd hope they would by the end of this year. In fact, if you look at somebody like Fannie Mae, who just revised their estimate earlier in the year, they were hopeful that mortgage rates would be down below 6% by the end of the year. And right now they're calling for them to end the year at about 6.4, 6.5%. So everything's been delayed a little bit. And hopefully inflation continues to go down as it has been most recently, and the Fed will cut those rates soon.
Is there any particular bellwether statistic or market metric that investors can look at that would be a sign that things are definitely trending in the direction of rate cuts?
The Fed looks at a couple of different indices. The most popular one, of course, is the Consumer Price Index, the CPI. That's the one probably to keep your eye on the closest. But the sticky part of inflation right now appears to be the services sector. And those prices have been stubbornly high and continue to be high. And it's not what people think. It's things like travel. So apparently the more affluent part of the population is spending a ton of money on things like travel right now, and those prices stay high. But there are also things that are outside of the CPI that really weigh on consumer confidence. We've seen gas prices go up year over year. We've seen food prices go up year over year. I think I've introduced you to my personal CPI, the Costco Price Index, where I talk about the fact that the salmon I bought a year ago was $9.99 a pound, and this year salmon is $12.99 a pound. And I think that's what the consumer is feeling in the consumer pocketbook, and why we're seeing consumer confidence scores be as low as they've been in several years. So there's a lot of these factors at work. There's probably not one indicator I would look at, the closest one probably being the government CPI. But this is it took an extraordinary amount of fiscal policy and monetary policy to get us into an inflationary mode. and it's just going to take a little bit of time for us to work our way back out.
So well said. Well, we'll leave it there today. Peter, thank you for joining us.
Thank you for having me.
Pleasure. Rick, as always, thanks for all the great content and look forward to next month.
Take care. Talk to you soon.
Bye-bye.